Okay, today in this unit, we've really been studying about cash and internal control over cash. And I thought I would take this opportunity to talk about the cash flow statement. You should have, again, downloaded your handouts before you started the video. And I have a statement of cash flows. This is the fourth financial statement. Way back at the beginning, we looked at the income statement, the balance sheet, and the statement of retained earnings. And I did not go over the cash flow statement. The cash flow statement is one we're going to be referring to in here, and I want to teach you a little bit about it, but we will not be preparing one from start to finish. But I wanted you to talk about the purpose of the cash flow statement. The cash flow statement shows us what all happened with our cash during the period. Do you ever wonder that with your own money? What happened to it? Where did it go? Where did it come from? Because so much in the business that we do is on credit. And this, on the cash flow statement, all we're going to have are just what cash came in for and what it went out for, grouped by categories. There's three main categories on the statement of cash flow. The first category is operating activities. You'll see here it talks about cash flow from operating activities. These are just the regular day-to-day activities taking place in the business. You'll see here they have, again, this is family health care we've been following. We have cash received from customers. Again, that's coming in. And we're deducting cash payments for expenses. So we actually have a positive cash flow of $2,600. And this is a very simple statement. Once you learn the concepts, it's easier to look at something that would be a little more. It is a required statement, a financial statement for companies that are publicly held. It gives information to the stockholders. The next section is groups investing activities. Think about those types of things you'd be investing in. Things that are long-term, like those fixed assets, investing in fixed assets for your business. This is going to be a little bit different than just the regular operating activities because you probably plan and budget for it in the future, just like you would with your own personal finances. You plan to buy a car or a home or something that you're going to keep for a while that would be a little more costly. So again, you're looking at any cash that came in if you sold a fixed asset or any cash that went out if you bought one. In this case, they have acquired land for $12,000, and so that was cash going out. The third category we have down here is financing activities, and by the name itself, you can probably figure out what that is, because what do we do in our own personal life when we want to finance something? We're talking about borrowing money usually, right? How are we going to finance it? Where's the money going to come from? And so because this is a corporation, another financing activity is selling capital stock, bringing on more stockholders. So any cash that we would receive from selling stock or from taking on a note would be in the add section. We're adding these in. And then anything that we've paid out to pay loans back, or if we pay dividends to our shareholders, that would be in the deduct section. So we take the adds. Here we have $6,000 plus $10,000, which gave us $16,000. We're taking out the cash dividends, which brings us down to, when we subtract those, we have a net cash flow from financing activities of $14,500. Again, this is positive. This was negative up here, our investing, because we spent money in that area, didn't bring any money in. And here's our operating activities. So when you take these three and you combine them, I say combine because you're going to have to subtract the negative number. If they were all negative numbers, then we would be combining the negative numbers. Okay, this gives us $5,100. This was a new business. If you remember, we started it back in an earlier unit. So there wasn't any cash at the beginning of the period. And that's what cash we have at the end. This is what's going to appear on our balance sheet. The cash that we'll have in our balance sheets right here is cash on the last day of the period. But this gives us a lot more information. Now we can see, well, we really didn't make that much money, but we did spend a bit, didn't we? And we did in our investing area, and we did bring in some money from our financing activities. Now I want to take a moment to talk about petty cash. What is petty cash? It would be a box, something like this, that the business would have with real cash in it. for those, expenses that they just are not going to use either electronic payment or a check or a credit. It could be as simple as paying extra postage when the postman comes, or taking the company van to the car wash. Every business usually needs a little bit of money around for small purchases. But what comes into play is, how are we going to account for that? When we have money sitting around, we need to have an internal control over it. Because again, in a business, this is the number one thing that's most subject to theft. People want cash. Even if all you have sitting around is $50 in a box, somebody's going to try to get to it. So you want to have a locked box, a box with a lock on it, that one person is in charge of. Because once you have, it's kind of like a cash register. When you go to the store, everybody has their own drawer now. You hate to get to Walmart when they're changing out the cash drawers, right? You have to wait, because everybody needs to be responsible for their own money. So I guess you could think of it like a cash register. And there needs to be a paperwork trail when money is taken out of it, and so that you can keep track of where it's going and that the purchases are authorized. So I'm going to talk a little bit about petty cash and analyze the problem that you have this week in your handouts is to analyze the effect of petty cash transactions on the accounts and on the financial statements. So as we look at these, we're going to look at what accounts are involved. Did they increase or decrease? What account types are they? And what financial statements do they appear on? Okay, so let's look at the first thing. The number one thing here is, it says, we established a petty cash fund of $1,000. Okay, petty cash actually becomes an account on our books. So when we establish a petty cash fund for $1,000, all we're really doing is transferring from the bank to the petty cash box. And you can think about that similar to the money that you have. You probably have money in the bank and you have money in your pocket. Hopefully you have money both places. So when you take it out of the bank, you're just transferring where it is. It's still cash. And you haven't spent it yet. It's just sitting there in the box. So the petty cash account would increase. That was one of the questions, right? And the cash account, our bank account, the cash in the bank, would decrease. And these are just transferring from one asset to another. And what kind of statement would this appear on? There's really two. The current assets on the balance sheet. Now we have a category for cash, and we have a category for petty cash. And it would also affect the cash flow statement that we just finished looking at, because all inflows and outflows of cash go on the cash flow statement. And it would be an operating activity, just a regular ongoing day-to-day activity of the business, not a financing activity or an investing activity. Okay, the second transaction here, it says the amount in the petty cash fund is $315. So we started out with $1,000, and now we're down to $315. And so we're thinking we need to replenish the fund. You don't have to wait till there's just a penny left in the box to decide that you need to replenish it. What should also be in this box is a record of what that petty cash was spent on. Okay, it says we spent $425 on office supplies. We spent $220 on miscellaneous selling expense and $40 on miscellaneous administrative expense. I think there's probably a lot of miscellaneous expenses that come out of a petty cash box, so this may be a good example. All right, so what happens when we replenish the petty cash box? Well, first of all, we started out with $1,000. So we want to put the difference between $1,000 and the $315 that's left back to bring it back up to $1,000. Unless you want to start keeping more money in the box or less, you'll write the check for the difference. And what accounts are involved when you replenish the petty cash box? Once we've established our petty cash fund, and this time in the beginning we established for $1,000, it just sits out there on our books at $1,000. Nothing happens with that. When we replenish the fund, we're going back to our regular bank account and taking it out, right? So when we take it out of our regular bank account to put it back in the box, we'll be decreasing cash for how much ever we take out, but we'll also be incurring a number of expenses. It's kind of a delayed reaction to recording these expenses. So we'll record office supplies, miscellaneous selling expense, and miscellaneous administrative expense. And I don't know if I talked about this earlier, but whenever you're paying an expense of any sort, the accounts are actually increasing. And I've had a lot of students in the past that have struggled with that concept. I'm paying an expense and the account is increasing. That's right, because expenses aren't a debt. They're just a category that you're putting that money in. So when you go to do your financial statements, you can see how much you spent on it. So it's just kind of recording how much you spent on that expense. So we'll actually be, again, decreasing cash and increasing all of those expense accounts, as well as office supplies, which is an asset. We bought some office supplies. Office supplies are not an expense until we use them up. What financial statements now, when we replenish the fund, would these things appear on? Well, we know cash appears on the balance sheet, right? We talked about that earlier. Any assets. The other asset we looked at here was supplies. On the income statement would be these expenses, the miscellaneous selling expense, the miscellaneous administrative expense. And then also, if it involves cash, it's going to be on the statement of cash flows. And that's all for this section.